Hey guys, Kevin Bupp here, and in this video we're going to discuss what a zero interest rate means to you. So the federal funds rate affects how much banks pay to borrow and lend, and so it impacts how much they charge you for other financial products and causes a ripple effect on other interest rates that you might encounter in daily life. That's what makes it a useful tool for the Federal Reserve when it comes to influencing the health of the economy. Simply put, lower rates give the economy a boost. Typically, when the federal fund rates decrease, so do the interest rates paid out on savings products like savings accounts and CDs. But it also tends to lower the interest rates you'll pay for debt products like automobile loans, personal loans, and credit cards. This makes it less worthwhile to save money and more worthwhile to borrow money, which encourages people to save less and spend more. So when the economy needs some help, the Fed can lower rates to boost consumer spending. And it works the other way too. When the federal fund rates increase, so do interest rates that you earn on things like savings accounts and the ones charged for things like loans and credit cards. This makes it more worthwhile to save money and less worthwhile to borrow money, which encourages people to save more and spend less. So when the economy seems like it's growing too fast, which can then lead to inflation, the Fed can raise rates to slow economic activity. And so let's talk about what a zero interest rate means in real life. Since the coronavirus pandemic brought almost the entire economy to a halt practically overnight, the Fed slashed interest rates down to as close to a zero as they could get in an effort to incentivize people to keep spending money so that businesses can keep making money and employees can keep getting paid so that people still have money to spend, and so on and so on. Now here's what that probably means for you. You'll probably earn very little, if anything, on savings. Many savings accounts interest rates are closely tied to the targeted federal funds rates because the federal funds rate is the amount that the bank earns on your deposits. If interest rates are set at 0%, that typically means that banks are making 0% on interbank loans. That usually leaves banks with one of three options. The first one is to pay interest funded by a different source of income. The second one is to pay interest and lose money on it. Or the third is to pay no interest until the federal funds rate goes up again. Now, low interest rates tend to make debt cheaper. If you have loans or credit cards with variable interest rates, those rates might go down. Also, now could be a good time to ask your loan or credit card provider to lower your rates. If you have credit card debt, you could also look for 0% balance transfer offers from other credit card companies. And so a quick recap on what we covered here. Interest rates go up, saving is good, borrowing is bad. Rates go down, borrowing good, saving not so much. In an economic crisis, near zero interest rates can really work to bring money back into the economy. But on the other hand, the crisis that we're in right now is not like any other that we've ever seen in history. Interest rates can't cure a pandemic, and events keep changing daily. And so, guys, we're pretty much in uncharted territory, and only time will tell how this all plays out. And so be safe and invest wisely. And with that, guys, that's all we have for today's video. I appreciate you watching. I hope it brought value to you and your business. If it did, please like it, and I look forward to seeing you on the next one. Take care.